Hello everyone, welcome to another video for CFA Level. In today's class, we will be taking up the topic of risk and return part 2. In the previous class, we started it with the concept of capital market line, where we understood in detail how a capital market line is like a capital allocation line, but with a specific market portfolio. In today's class, what we will do is that we will deep dive into the risk and understand how we can understand risk in a more appropriate manner, more better manner, and build a strong foundation on risk. Okay. So in the previous class, we had done two topics: capital market line and active and passive investment. In today's class, we will start with risk deep dive. Okay. Types of risk. See, when we are talking about risk, we have already had a glimpse about the risk when we were doing risk and return part 1, where we have read about risk measures, right? In risk measures, what are the major things we have seen? We have seen variance and we have seen standard deviation. Okay. When we were seeing variance and standard deviation, what we were seeing is a complete total risk as a whole. Okay. Now what we are doing is that we are breaking that risk into two parts. Okay. This total risk is broken into two parts. One is the systematic risk and the other is the unsystematic risk. Okay. So we need to understand an important point over here is that we are breaking the total risk. So it is not a different category of risk altogether, or it is not a different thing we are trying to study. We are just deep diving into the total risk which we have seen in the part 1. Okay. Total risk divided into systematic risk and unsystematic risk. What is systematic risk? We will study. Systematic risk are those which are non-diversifiable, inherent in the overall market and market risk. So what it is saying, what is non-diversifiable? Okay. What is non-diversifiable? It means that non-diversifiable means that risk which will not reduce or eliminate because we are adding more / different securities in a portfolio. Okay guys, we have all seen in the portfolio variance topic that when we are adding two securities in a portfolio, the overall risk profile of that portfolio is different from the risk profile of the two securities. Why? Because they are influenced by the correlation between the securities. Okay. So the risk profile of the portfolio is different from that of the security. But over here, in case of systematic risk, what we are saying that irrespective of the securities that we put in the portfolio, this risk cannot be reduced or cannot be eliminated. Why? Because they are non-diversifiable. What does it mean? That irrespective of what security you put in the packet, security A, security B, security C, security D, this risk, this systematic risk will be there in all the securities. Okay. So this risk will be there in all the securities. Are we clear? Are we clear? So irrespective of the securities that we are putting in the packet, this risk will be there across, and that is why irrespective of what securities you are putting in, you cannot diversify it again. Okay. See, that is why it is writing inherent to the overall market. What is overall market? Means collection of securities, inherent to all the securities together. Okay. Now let us go to unsystematic risk. What is unsystematic risk? They are unique, diversifiable or firm specific risk, local or limited to a particular asset class or industry. So what does it mean? It means that these kind of risks are different for security A, different for security B, different for security C, different for security D. Okay, and when you put them in the packet, you are actually able to diversify your packet or diversify your portfolio, because the overall risk not only depends upon the individual risk of security but also how different securities interact with each other. So this can be diversified, and that is why we are saying that undiversifiable risk are local risk or restricted risk. Okay, so this risk will only belong to security A, or this risk will only belong to security B or D or C or anything. Are we clear? Are we clear about the deep dive of the type of risk? Okay, see, this is a very important graph that you must understand. Okay, I hope it is visible to you guys now. See, this is a graph which is very, very, very important for you guys to understand. Okay, see what it is saying. See, total risk is nothing but systematic risk plus unsystematic risk. This is something which we have seen in the previous topic. Okay, the y-axis is the risk over here, and the x-axis is the number of securities in the portfolio. Why? We all know, as you increase the number of securities in the portfolio, the interaction of one security with the another results in the portfolio risk being very different from the individual securities, right? Right? Why number of securities is important? Because of the correlation of the securities, interaction or correlation of the securities, and resulting portfolio risk. Are we clear? See, if you look at the graph, what it is saying, it is saying this is the one which I am highlighting, this is my total risk graph. Okay, this is my total risk graph. But if you will see, after a point of time, irrespective of the fact that I am increasing the number of securities, my risk is not going down. Okay, so let us draw it over here and understand. See, just a second. Irrespective of the fact, this is risk, this is number of securities. Okay, and this is the total risk curve. Okay, if you see beyond the point, the fall in the risk, this is the fall in the risk, and this is the increase in the number of security. So we are seeing that beyond a point, when you are increasing the number of securities, the risk is not falling. Why? Because beyond a point of time, the risk that you are exposed to is the systematic risk. And what we have learned, that systematic risks are non-diversifiable risks. They are risks which are inherent in the market. Okay, so irrespective of whether you choose 50 security, irrespective of the fact that whether you are choosing 500 securities, you won't be able to diversify it. Okay, and any risk above the systematic risk is known as unsystematic risk. See, as you can see, as you are increasing the number of securities, unsystematic risk is coming down. Why? Because there are more number of securities in a portfolio to interact. See, as you are increasing the number of securities, the unsystematic risk is coming down, but it is getting stable at a point of time. Why? Because at that point, it is only exposed to systematic risk or market risk. Are we clear? Okay. Now at this point, we will have some of the things to study. Points to note. Capital market theory assumes that diversification is free of cost, and hence investors will not be compensated for bearing risk that can be eliminated at no cost. So what are we saying? The first point is very important, guys. You need to understand. Okay, and the first point will form basis of a lot of theories that we are going to study in the future. Okay, what it is saying, that diversification is free of cost. Okay, what is its implication? Its implication is that since diversification of is free of cost, which means to achieve or to be able to reach a point where your risk is as near to the systematic risk is not difficult. Let me repeat it again. Since the capital market theory is saying that diversification is free of cost, which means that in order to be able to reach to a point where your total risk is just as close to your systematic risk should not be a difficult task, correct? Correct. If it is not a difficult task and if it is free of cost, then the capital market theory is saying that even it is being free and you are not doing it, you are taking a higher risk, then why we should compensate you for it? And thus, capital market theory is saying that we will not compensate investors for taking unsystematic risk. So, what is its implication? If total returns are based on total risk, okay, so eventually total return is based on nothing but systematic and unsystematic risk, correct? Now, if I apply this logic, and merge this with capital market theory, then your total return should be based on systematic risk. Why? Because there is no compensation for unsystematic risk. Are we understanding? See, we all know total returns are based on total risk, and total risk is nothing but a sum of systematic and unsystematic. If capital market theory is saying that diversification is a free of cost affair and investors are not compensated for unsystematic risk they take, which means your entire return is based on systematic risk. Having this concept understood, there are important return models based on it, where where we will calculate the expected return of a portfolio based on just systematic risk. Are we clear? See, in the earlier chapter we have seen return measures where return is based on total risk. Point number one. Second, we have understood about capital market theory, which is saying that total risk can be broken into systematic and unsystematic. Unsystematic risk can be diversified away and investor will not be compensated because of it. Since we have come to a point in the capital market theory where total return is based on systematic risk, now we will learn return models which are just based on systematic risk. Are we clear? So that single line had such important significance. Now, let us see. Returns are based on systematic risk that an investor undertakes. We have already seen. Thus, it can be said that riskiest stock as measured by SD does not necessarily have the greatest expected return. Correct. What it is saying? it is saying that if you calculate the standard deviation of a stock and if it is very high, you will classify it to be very risky. Since it is very risky, you will classify it that it should give me high return. But what it is saying that it may not be possible. Why it may not be possible? It may not be possible because your total risk is a combination of systematic and unsystematic, and it might be possible that the standard deviation that has come so high, showing the total risk is higher, is just because of the unsystematic risk. Are we clear? Last point: systematic risk can be measured by the contribution of risk of a well diversified portfolio. So what it is saying? It is saying that if you need to compute the systematic risk of a portfolio, you should well diversify it and then compute the total risk. Because of well diversification, it is assumed that unsystematic risk will go away. So the total risk is approximately equal. What it is saying that total risk will become approximately equal to systematic risk. Are we clear? Guys, are we clear? Cool, guys. So today we will keep the video at this point. I hope this deep dive into risk was helpful to you guys. In the next class, we will start with the return models, which are primarily based on systematic risk. Till then, happy studying.